how bad is this recession actually going to be?
It has the potential to be pretty bad. And the thing that's going to determine how bad it actually is going to be the Federal Reserve Bank, because the Federal Reserve Bank is the entity that's right now trying to fight inflation. And the reality is the inflation fight is inducing a recession. And so if the inflation fight is causing a recession, the question is, how aggressively are they going to get to fight inflation? Because the more aggressive that they are to fight inflation, the bigger the recession is going to be. And now, if we focus on the recession, because we have to separate inflation from the recession, and I'll explain what all this means. So if you're confused, just stick with me. But if we separate inflation from the recession is an economic slowdown. And right now, there's kind of two different industries, sectors that are struggling from the economic slowdown. Two big ones. We have the tech side, and then you have the real estate side. Both of them are getting hit because of interest rates, but for different reasons. On the tech side, the Fed started raising interest rates to fight inflation. But you have all these tech growth speculative companies that popped up over the last number of years, and they're a byproduct of this bubble economy. And what I mean by that is they're a byproduct of the cheap money economy, where you could borrow money for essentially nothing, and where banks and institutions and investment firms had piles and piles of cash that they were just looking for places to throw it, to invest it, because they were able to borrow money, and the government and the Fed were printing money like crazy and throwing it into the economy. So the Fed and the government printed money like crazy, and now banks and institutions have all this money that they need to invest, that they were just throwing it anywhere because they needed to put it somewhere. And one place that was a very hot place to put it was these tech companies, because when the pandemic hit, the world shut down, everybody went on their phones and their cell phones, and everybody was spending all their time on technology, and everybody assumed that these tech companies were going to take over the world. And yeah, technology has a huge place, but everybody thought that this pandemic economy was the future. So a couple big examples of this are like Peloton. Everyone thought that no one's going to want to go into the gym again. Everyone's going to want to work out from the comfort of their home, their living room with the Peloton. Well, turns out that some people didn't. Some people wanted to go back to the gym. Now, gyms haven't gone up to full capacity. I like going to the gym. And I know a couple of the gym managers where I go, and they said that they're not at 100% to where they were before the pandemic. They're at 70%, but it's not 20% like it was during the pandemic. So Peloton's been hurting. Netflix has been hurting. A lot of these tech companies have been hurting. And these are the companies that are more established. You have a whole array of companies in this tech space that have little revenues or no profits. And they've been able to get millions, if not billions, of investment dollars to grow as big as possible, as fast as possible. And for these companies, a profit was looked at as a bad thing, because if you had a profit, that meant you had dead cash sitting in the bank. Because if your company has, say, $10 million in the bank, an investor is going to look at you and say, why? Why do you have $10 million in the bank? And you might say, well, we want to protect ourselves because if something bad goes wrong, we want to make sure we can make our payroll and we can make our rent and our mortgage payments. But the investor is going to say, that's $10 million of dead money. You could use that $10 million to buy more users, to run more advertising, to invest in more infrastructure, to invest in more growth, to do more innovation. So to these startups, you don't want to carry a profit, especially if you're trying to raise money, because it's looked at as a negative. And so you had this whole array of companies that were not profitable, that were surviving on investment dollars from banks and institutions, which had an unlimited amount of money thanks to low interest rates and free money. But now that environment is changing. Interest rates are going up. That free money is not there anymore. And so now these companies that were relying on the banks and institutions for this free or easy to access money are now going to the banks and institutions saying, hey, we need more money. We have no more money to pay our employees. And then the banks and institutions say, sorry, either do we. And they're saying, you need to show us that you're profitable. You need to show us that you're a real sustainable business. Otherwise, we're not going to invest in you. And these companies are saying, oh my God, how do we do that? Well, in order for you to show that you're a sustainable company on the financial side, you need to show bigger profits or a profit. That means you need to grow your revenues and cut your expenses. Now, how do you do that? Well, in a recession or a slowing economy, it's harder to increase your revenues because that means you got to charge more money or you got to create more products that people have to pay for. And that's tough when people are struggling to pay their rent and their groceries and their gas. So it's tough to increase revenue. The second flip side is cut your costs. So what's the most accessible way to cut your costs? Let people go, lay people off, fire people.
Yeah.
And so we're already seeing that side happen in the tech sector. In the real estate side, it's similar, where real estate was really propped up thanks to the help of low interest rates. Remember, the Fed cut interest rates to the lowest rates in the history of time during the 2020 pandemic into 2021 because they wanted to stimulate the economy. So they cut interest rates. Now everybody wants to buy a home, take advantage of these low mortgage rates. People want to get a home where they can work from home. And so when you have all this demand to buy a home without that much growth in supply, what happens? Home prices shoot up. So now we have the highest home prices ever. We saw more than a 20% growth in home prices in the last year. We saw more than a 20% growth in rental prices in the last year. And now mortgage rates are skyrocketing. Mortgage rates have doubled since the beginning of 2022. So within 1 year, like in 6 months of 1 year, mortgage rates literally doubled. What does that mean? Well, now you want to buy a home. You think you're going to pay $1,500 a month, but you get to the closing table and it's going to cost you $1,800, $1,900, $2,000 for the exact same home when you thought you were going to pay $1,500, but you were looking at it at a lower mortgage rate. And so that's going to hurt the housing market, and it already is. We've seen mortgage demand fall significantly. It's falling like a rock. And so, just understanding what does that mean? Well, that hurts mortgage companies, lenders, bankers. You've seen, I don't want to say layoffs, but job losses, because many of these companies have these bankers as contractors, or they're just commissioned salespeople. So instead of laying them off, they just don't get paid, and then they leave. Like there's a big mortgage lender here near us, near our office. They let go of 8,000 people. But it didn't hit the news because it's not traditional layoffs. It's just these are people that are not making any money because they're not closing any deals because people aren't getting mortgages. And so you're seeing that across the mortgage market, across banks, across lenders, where the mortgage industry is getting hurt. But then that also trickles down to title companies and contractors and all the other real estate people. So that's the first domino that I call, right? You have the real estate industry and the tech industry. Now the question is, what's going to happen next? Is this going to trigger a second domino, or is the Fed going to trigger a second domino? And the reason why this is so important is because our financial system works in a bubble almost. I don't want to say the word bubble because when people think bubble, they think of something else. But it is kind of like a bubble where everything affects one another. Because you might say, oh, that sucks for tech companies, or oh, that sucks for people who are bankers. But what you have to remember is those employees that worked at tech companies or the bankers, they have mortgages. They have car payments. They go to the grocery store. They go to Gucci. They go to Louis Vuitton. They go to Chipotle and buy the extra guac. And when you lose your job or you lose your income, guess what? You're not doing that. You can't pay your mortgage, or you can't make your car payment, and now you can't go to the grocery store. So what does that do? That starts slowing down the next aspect of the economy, right? We talk about dominoes. And there is a lot of recession indicators. I mean, if you go to listen to any of the traditional financial news sites, everything is a recession indicator. Guac prices isn't a recession indicator. Copper prices are a recession indicator. Home prices are a recession indicator. Credit card debt is a recession indicator. But another one, a very popular one, is known as a major recession indicator, is car repossessions. Because when you start struggling with your money, one of the first places that people stop paying is their car. Because you need a car, but you need your home more than your car. And so people look at car repossessions as a recession indicator. And what we've been seeing is that car repossessions have been skyrocketing. I forget who it was. Barron's released an article, I believe, on the title was something like car repossessions are going through the roof, or they're skyrocketing, where it talked to a car dealer who explained how he's been going to these, buying these repossessions before they go to auction, and how he's been seeing a massive, massive influx of new repossessions because people have been buying cars in this pandemic era economy. And what he said was essentially during the pandemic, people were wealthier than ever, and they used this wealth to go out and buy cars. And the reason why he says people were wealthier than ever is because, one, they had no expenses. Remember, we had the mortgage forbearance program going on. People were not paying their rent. The student loan forbearance, we have no expenses because now the economy shut down. So you're not going to the mall, you're not spending money out.
Right.
So people had no expenses, but incomes were significantly higher than normal because you had people that are now getting stimulus checks, people that are getting unemployment checks. And for some people, these unemployment checks were bigger than their regular incomes. And so you had people making more money than ever during the pandemic when we're in supposedly the worst recession since the Great Depression. And people have no expenses. So now people felt very rich. And what do? Well, some people saved their money. Some people invested their money. Some people paid off debt. But you had a big chunk of people that went out and bought cars. Mm-hmm. And so they bought cars that were outside of their income range. And he says that he's never seen so many people earning $2,500 a month with a $1,000 a month car payment.
Wow.
Which is crazy to think about. Your car payment is almost 50% of your gross income. And now, as you know, life is getting back to normal. Well, now people can't make those car payments. And now that the economy is struggling, right? You have high gas prices, you have high grocery prices, everything is expensive. Well, that's where people are saying, I can't afford this car payment anymore. And they're just not paying it. And that's why repossessions have gone up. Now, on the other side, you also have kind of the scam side of the repossessions where, if you remember the PPP loan, apparently he was talking about, kind of funny, that he repossessed like Aston Martins and Bentleys and these nice cars from either real or fake businesses that scammed the PPP program. And they took that loan money, went out and bought one of these fancy cars. And he's like, I literally repossessed the car less than 6 months after they bought it because they couldn't afford the monthly payments.
Just a long joyride.
Yeah, literally one long joyride. So, you know, you're seeing this rise of repossessions. And so the question now, going back to what I said in the beginning of this video, is what is the Federal Reserve Bank going to do? Because they can either fight inflation or fight a slowing economy. They can't do both at the same time. Because in order to fight a slowing economy, you have to create more inflation, meaning they cut interest rates or they do quantitative easing or they do stimulus. However, on the flip side, if you want to fight inflation, you got to get rid of inflation. That means you got to get rid of money. That means you got to raise interest rates. You got to pull money out of the economy. And this is where, like I was saying, when you fight inflation, you're inducing a recession. The stronger the fight on inflation, the deeper the recession. Mm-hmm. And right now, as of today, the fight on inflation is significantly more important. I think it's always more important, but according to the Fed, right now it's more important. Meaning, they're going to raise interest rates more. If they raise interest rates more, that means borrowing money becomes more expensive. Mortgage rates go higher. Your car payments are more expensive. Credit card debt becomes more expensive. Business borrowing becomes more expensive, so it slows down the economy more. And this goes back to the question then of what's going to break first. Is it inflation or the economy? Because if the Fed can now raise interest rates a little bit more and inflation starts to just crash down, well, inflation broke, but hopefully the economy didn't, right? The economy didn't break. Yeah, we saw a little bit of a slowdown, but hey, inflation's back down to normal, but the economy is fine. We're good. But if that doesn't work and the Fed has to keep raising interest rates and inflation doesn't break, well, eventually the economy is going to break because we don't know where that, it's like a teeter-totter, right? Mm-hmm. How much weight can we keep putting on each side? And this is where the Fed is playing this balancing act where originally they said that they want to induce a soft landing, right? They don't want to hurt the economy. They want to fight inflation without inducing a major recession. Well, the more and more they try to fight inflation, it's not working still. And the question is, how much more are they going to have to raise before we see a significant decrease of inflation? And if we don't see a significant decrease of inflation soon, the economy is going to get hurt each and every time we raise interest rates. This is where, you know, there's no answer. Because, I mean, just thinking about this logically, the federal funds rate, interest rates are like under 2% right now.
Right.
Inflation is around 9%. So, I mean, just thinking about it theoretically, you're going to have to raise interest rates quite a bit to really bring this inflation problem down. And now, okay, if you do that, that's going to hurt the economy. But the second question is, are they going to do that? Because the question is the Fed going to actually stick true on their fight to bring inflation down if the economy starts to struggle? Because you got to remember now, the Fed, although they're an independent organization, they don't always act independent. Yeah, exactly. They don't always act independent. They're supposed to be, but at the same time, they can be enticed by people or the government to say, hey, look, layoffs are happening too much. Unemployment is going up. The economy is slowing down. It doesn't look good. Can you help us out? And so they might say, all right, we're going to turn on the money printer again. Instead of raising interest rates, we're going to cut interest rates. Instead of fighting inflation, we're going to create more inflation. And now what are you doing? Well, you fix the economic issue in the short term because now you start creating more of that free and cheap money. Banks and institutions have piles of cash again that they can just throw into these companies. You'll see markets go back up. Home prices will shoot up even higher. And you'll just see more money out there, but that creates more inflation. It doesn't solve the inflation problem.
Right.
And the reason why that might happen is because there's still such a big debate as to what causes inflation. Ever since the new CPI report came out, which said inflation CPI is 9.1%, every day on the news, you've had somebody from the White House come out and say, this is why we need to pass this new stimulus bill or this new infrastructure bill to improve the supply chain. And so we need to spend more money in order to fix the supply chain, which will help inflation. But those are two separate issues. Inflation and the supply chain concerns are two different things. Inflation at its core comes down to one thing, money printing. When you print more money without creating more wealth, the value of each individual dollar goes down, causing the price of things to go up. The supply chain issues and concerns, like issues with the chip shortage, issues with Chinese manufacturing, all these things are not inflation by definition. They're temporary price interruptions. Yes, if we fix the supply chain, that's going to fix the temporary supply chain interruptions. That's going to fix those temporary price interruptions, but that doesn't fix the true inflation problem. Because if our issue was just supply chain issues, you don't got to worry about raising interest rates. The only thing you got to do is give it some time, let the bottlenecks ease up, and let producers produce more stuff. But that's not the case. We have actual inflation. We printed more money in the 2020 and 2021 pandemic than ever before. And so there is a cost to that. And that's where now we have to do that fight on inflation to bring that real inflation down. And that is painful. And this is where there's all that debate of, oh, it's just supply chain. But it's not. They're two different things. And this is where, you have the economists fighting with Wall Street, fighting with CEOs, and the Federal Reserve Bank. This is why I say, we don't know what the Fed is going to do. So, when you asked me how bad is the recession going to be, you can't predict it because we don't know what the Fed is going to do. We know what the Fed should do. We don't know what they will do. So there's a kind of a discrepancy there between what's going to happen and what people think should happen.
If these dominoes keep falling and the U.S. does see a recession sometime soon, what can the majority of people do to kind of prepare?
Well, the first question is, not necessarily a question, is we might already be in a recession. And these terms are really just arbitrary things that can kind of be massaged. A recession, by definition, is 2 quarters or 6 months of economic slowdown. Well, if you look around you, people feel poorer today than they do 6 months ago. And so whether or not you're in a technical recession, the average person is in a recession right now.
Right.
So now the question is, what do you do around you? What you do is you're going to have to take care of your own financial health. You're going to have to take care of your own financial education, because the reality is, if you just rely on the government or the Fed, you are going to get screwed over. Look, if you're on a fixed income, like people who are retirees who relied on the government through Social Security, they are getting hurt. After 2021, Social Security earners got the biggest Social Security pay raise in the history of time. It was like, I think it was 5.6%. It was something that ranged 5 to 6%, if I'm not mistaken. Well, Nice, you got a 5.6% raise in Social Security, but guess what? The cost of living is 9% higher. So yeah, you got a raise, but you're poorer now than you were before. So the people that relied on the government to take care of them are getting hurt by the entity that said they would take care of them. This is why you can't just blindly trust or believe everything that the government and the Fed says. Now, we can assume, we hope that they have no malintentions, and that's fine. But this is where you have to really just take care of yourself, because you need to make sure that you are taking care of yourself, your family, and your community. So what does that mean? That means now, one, putting cash aside for two reasons. One is for protection. One is for taking advantage of opportunities that come your way. Because on the protection side, we don't know how much worse it's going to get. If we stay true on the fight to inflation, it's going to get worse. And the fight on inflation is painful. However, it's not as painful as not fighting inflation, because if we don't fight inflation, we print money, institutions, banks, everyone has hordes of cash. Well, then the next thing that happens is inflation gets worse. In the short term, we feel richer. It causes an economic boom. But then eventually that money starts to flow through the economy, and people and businesses realize that your $100 can't buy you as much as it could. Your $1,000 can't buy you as much as it could. That $300,000 you had for a home can't buy you that much of home as you would have expected. And now you see a bigger divide between the haves and the have-nots, and the inflation problem gets even worse, and that makes the recession even worse. So this is where, we don't know what's going to happen, but you want to prepare and protect yourself by first having cash put aside to protect yourself. Second is having investments or cash to take advantage of investments that come your way. And the reality is, when you have these types of swings, recessions, market slowdowns, volatility, it creates opportunity for investors, because at the end of the day, investing is buying something that makes you money. That's what an asset is. You're buying something to make money.
Right.
Well, the best time to buy something that's going to make you money is when you can buy that thing at a cheaper price, right? You're buying it on sale. Mm-hmm. Well, when you have these types of economic slowdowns, you have toxic assets. You get people that get scared, people that panic, people that sell their good assets at a discounted price. Now, they're either selling it because they need the cash or because they're scared. And in either case, that creates opportunity for you now to come in and buy a good asset at a discounted price. But that requires you to have the cash and to know what to buy. So that's why you want to, in a good time, start preparing. Now, what do you buy? So I invest my money in 5 places. I invest my money into my own business and startups, right? Market Briefs is our company. I invest cash there into startups. I invest money into real estate, stocks, cryptocurrency, and physical gold. You don't have to invest your money into everything, but you have to know what's important to you. I'll go down to up. For physical gold, I own gold not really as an investment where I'm looking for a return, but it's more of like insurance. I look at it really as a savings account, but saving hard money, because gold is a better store of value. Actually, I saw this quote. I'm going to show it to you right now from Alan Greenspan, a former Federal Reserve Bank official. And he says, I got it, quote, "In the absence of the gold standard, there's no way to protect savings from compensation through inflation. There's no safe store of value." Essentially, when you run on this fiat money, this cash system, this dollar system, which is not backed by any hard asset, well, the government and the Fed have free reins to print more money, which creates inflation, and that makes the people who are not financially educated poorer, while making the people who are financially educated richer, because now you own assets that benefit from inflation. And so gold for me is just a way to save hard money. Nothing else. Like, I don't really care what happens to gold prices. I don't really monitor it that much. Like, I do look at it here and there. It's in market briefs every day, so I look at it. But it doesn't change my strategy. I buy a little bit of gold every month on a passive system, and that's it. It's just an extra savings. Crypto, similarly. Crypto is my speculative, risky investment. It's kind of like my fun investment. I believe in the future of crypto. I think blockchain has a lot of technology implications and usage that will be around in the future. I'm way more worried about the crypto exchanges than I am the future of crypto.
Right now, yeah.
Especially right now. And this is things we've been talking about for a long time now. Mm-hmm. But like I've been saying, never keep your crypto in an exchange. Use an exchange as an exchange, then take your crypto out of the exchange, put it in a wallet. So just be aware. But, it is not crypto is one of my smallest allocations in my investment portfolio. But I buy some crypto every day, some Bitcoin, some Ethereum, and a couple of the other coins. But that's it. I don't really care what happens to the price of crypto. I'm buying it when it's up. I'm buying it when it's down. It's passive. If I see a big crash, yeah, I might come in and buy some more. But for me, it's more fun. It's speculative, and I know the risks that are involved. If it goes to zero, it's not going to kill me. I'll be just fine. But I do believe in the future of it, which is why I'm buying it. And I think there's a lot of value that's going to come into crypto in the future. Then moving up to stocks, I invest in two different ways in the stock market. One is my passive strategy. One is my active strategy. My passive strategy is every week, every Wednesday for me. You can pick the day. But every Wednesday, I have money that leaves my account. I use M1 Finance. They're a sponsor and affiliate for Minority Mindset. Full disclosure, if you want to learn more about them, the link is in the description. But the way that I use M1 Finance is literally every Wednesday, money leaves my bank account and gets invested into a portfolio of just ETFs. These are ETFs, or these are funds that give me exposure into a bunch of different types of investments. So things like the S&P 500, which are the biggest 500 companies in America. I have some dividend-paying ETFs. I have some emerging market ETFs, which are companies that are outside the United States that transact in a currency that is not the dollar. So they transact in a different currency. Mm-hmm. So, higher risk, but also protection against the United States. I invest in some innovation and some technology. Again, more speculative. I invest in emerging markets, innovation. I'm forgetting what else I invest in. But, just a number of different ETFs that give me exposure to the general market and some value companies. So things that I like, things that I believe in, that I want to own for the long term. Again, this passive strategy happens whether the market is up or down. It does not matter. It happens every week. Then I have an active strategy. Now, I've been pulling away from my active strategy because I've been investing so much more aggressively into market briefs. So, it's just a matter of where to put my cash. But generally, my active strategy is I'm looking for investment stocks, individual companies now that I like, that I read the earnings, that I believe in, that I think is a good buying price, and that's when I come in and buy. The way that I would do that is I'll wait for the price of one of these companies to fall by 10 to 15%. Now I see it's on sale, and I come in and buy. And if it falls by another 10 to 15%, then I buy more. If it falls by another 10 to 15%, I buy even more aggressively. So I buy in phases, not all at once, and I buy on the way down. And on the way down, the further down it goes, the more aggressively that I buy. Then I have real estate. Real estate outside of my own business is probably my favorite place to invest because I own something tangible, something real, something I can see, feel, and touch, and something that provides cash flow. So when I go out and buy a rental property like a home or an apartment complex, you can see the property, right? There's land, there's bricks, there's windows, there's doors, there's AC units. Like there's actual things there that provide value. And so I like that because, the price of real estate can never really go to zero. Even if a building burns down, you have insurance. But even if the building burns down, you still own the land. So there's that value with real estate. And it provides cash flow, right? As soon as you buy a property, for me, I buy properties for cash flow that I want to own forever. These are nice properties in good areas. People, I don't want to own crappy properties. I own nice properties that I make really nice. I put in nice appliances. I put in nice things and then rent them out. And that provides consistent cash flow that's pretty passive for me because I built the right teams to have a property management company. And so I like that type of real estate investing. And then we have the business and startups. So like Market Briefs, our financial newsletter, the company that I created where every day you get the free financial breakdown of what's happening. That is my number one investment right now where I'm working to grow that, my time and money to grow that into something bigger, which is why if you have not subscribed to Market Briefs yet, make sure you do that. The link is down in the description. You already know below. But with Market Briefs, this is where now we're trying to break down what's happening in the markets, what's happening in the world, what's happening in the financial world. So it's accessible so regular people can understand what's happening because most of us don't know it. I never understood the financial news growing up. I never understood financial education. No one ever taught me this stuff. So that's where Market Briefs tries to help break that down. And for me, I have that purpose value for it because this is something that I never grew up learning, but I see now how important it is because if you don't understand money, if you don't understand what's going on, you're going to be intimidated. And if you're intimidated, you're not going to do anything. If you don't do anything, you're sitting on the sidelines while other people are getting rich. And it starts from that basic education. And it sucks because none of us are ever taught this stuff. So trying to demystify that on the market brief side, but that's on my purpose. But on the financial side, it's a place for me to invest money that, can grow regardless of what type of economy that we're in. And if you want to invest in businesses, there are platforms out there that allow you to invest in startups. Start Engine, Republic, WeFunder. These are all crowdfunding platforms. I have to disclose that I am an investor in WeFunder, the platform. But these are all platforms that allow you to invest in startups. And when you see economic slowdowns, you see recessions, you see the valuations of companies drop. So you will see, most likely, companies that are desperate for cash. And they need money to keep going. And so they will be willing to sell a portion of the company at a discount. Now, again, this is extremely risky. Some of these companies will fail. In fact, many of the companies will probably fail. However, if you can find a good company and you can invest in it, you have the potential for a lot of returns. So it's high risk, high potential reward. And the thing is, when you invest in a startup like this, you don't get paid unless that company gets bought out or unless they go into an IPO. So your money literally just disappears, and then you have to hope that the company does something. So it's high risk, high potential return. But the whole idea now is, what do you do? It's be prepared and then take advantage of opportunities. How do you take advantage? Find the right asset that I just talked about and buy it at a discounted price. And then let the economy grow, because the reality is, a lot of people have this really negative idea what's going to happen in the world and the economy. But the reality is we will get through it. The United States will thrive. We will do just fine. But it's going to be painful until we get there. And during that pain, that downturn, that dip, that's where you want to come in and buy. So once the economy starts to grow and thrive again, now you already own the assets that become so much more valuable.
A lot going on, but it's comforting to know that there's options.
Absolutely. There's options and there's opportunity. And this is where I've talked about this before, but the whole idea of a recession and market crash makes a lot of people uneasy and anxious and scared. But for the minority of people, for investors, it is great news because it creates opportunity for you. And it's the whole idea of thinking differently than the majority of people. Because when majority of people are scared and running away, that's when you want to be coming in and buying. Because you don't want to just keep doing what everybody else does.
Absolutely.
Well, that was a great session, Nate. If you want to see more of Nate, check him out on his channel, Nate Gregory. Thank you for watching. And as always, keep hustling. You have to have a long-term mindset if you want to succeed in the stock market or any asset class, because over the long term, the people that make the most money are investors who invest for the long term, not just short-term traders. And so you have to have that financial focus and not get carried away by the day-to-day swings.